bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 12th, 2025 episode. Welcome to all of our YouTube viewers and podcast listeners. And those of you who are watching, you can see that my guest today is my partner, Tony Grappone. And yes, you guessed it, this is the latest installment in our Renewable Energy Tax Credit Finance series. And this is a highly timely and anticipated episode of Tax Credit Tuesday. We're going to talk about the One Big Beautiful Bill Act, also known as H.R. 1. H.R. 1 is the sweeping reconciliation legislation that was signed into law in July by President Donald Trump. And as we've discussed before on this podcast, the reconciliation bill has widespread implications for community development tax incentives. We've had separate podcast episodes covering the bill's implications for the expansion and enhancement of the local housing tax credit and for the permanence of both opportunity zones and new markets tax credits. And we will include links to those episodes in today's show notes. Now, unfortunately, the reconciliation bill also rolls back many tax incentives for clean energy. And that's the focus of today's episode. We're going to first start with the changes that are made under the One Big Beautiful Bill Act to clean energy tax credits, or at least some of the key changes to the broad swath of Novogradac clients. Second, we're going to discuss some of the financial and investment implications of those legislative changes. Third, we're also going to discuss the Foreign Entity of Concern, or FEOC restrictions, and how they affect a project's ability to qualify for clean energy tax credits. Fourth, we're going to also discuss some steps developers and investors should take in response to these new rules. And fifth, we're going to discuss some of what we expect to be released in terms of Treasury guidance or technical corrections or follow-up legislation. I also want to note that Tony and I will be in person at Novogradac's 2025 Fall Renewable Energy Tax Credit Conference. It'll be held at the Fairmont Hotel in Washington, D.C., Thursday, November 6th to Friday, November 7th. That'll be a great place to meet Tony and me in person. And also, it's a day and a half covering a lot of what Tony and I are going to attempt to cover over the next 45 minutes or so. So obviously, the conference will have a lot more in-depth information and more updates. So we encourage you to join us. We have a lot we're going to cover today. So if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday. You're probably not counting, but my team, my Tax Credit Tuesday team is counting. And this is your 29th appearance on the podcast. Now, I know to our regular listeners, you need no introduction. Even our periodic listeners, you probably don't need an introduction. However, the good news is we're always expanding our audience. And I'm sure there are some first-time listeners or viewers to our show. So please start and briefly describe the services you provide to Novogradac clients in the area of renewable energy.
Thanks, Mike. Okay, so this is my 29th episode. I'm starting to feel like, if you think back to Johnny Carson.
Yes.
All right. I am your Jay Leno.
You know my David Letterman?
No, well, I think Letterman predated Leno. Okay.
Enough.
So, right. So if I said Letterman, that might be dating myself even more. So I'm going to go with Leno in this regard. I didn't say Joan Rivers. All right. So yeah, great to be back. Love doing this series. And as far as services that I help oversee here at the firm, I get to oversee 3 different silos of services. I've got one group that focuses on transaction and advisory related work. And when you think of transaction and advisory, think financial forecasts, HLBV models, services to help document compliance with things like prevailing wage and apprenticeship criteria, documenting when facilities commence construction, satisfying the domestic content rules, and as we'll see going forward, helping clients document compliance with things like FEOC requirements. So that's transaction advisory. I've got another group that specializes in what we call in the CPA world, we refer to as attestation services. And those are things like auditing financial statements or reviewing financial statements. And then I've got a third group that specializes in preparing tax returns. So we do some transaction advisory work, a lot of financial statement audit work, and then obviously tax return preparation services.
Right. Thank you for that, Tony. And let me also note that in addition to all of that, you also have a practice area in affordable housing and other tax incentive related areas, and that you serve as the lead on the Novogradac Rural Energy Tax Credit Working Group, which means that Tony's very heavily involved in working with various renewable energy stakeholders to provide feedback on clean energy legislation and regulations, and submit comment letters on what we're looking to see in regulations before they come out. And that is a group that Tony leads on a monthly basis. And if you're not already a member of the Renewable Energy Tax Credit Working Group, I encourage you to join. With that said, Tony, this podcast is about the clean energy provisions that are in the One Big Beautiful Bill Act. And most notably, they roll back various clean energy tax provisions. Please start by sharing an overview of the major provisions affecting clean energy tax credits.
Great, thanks. Yeah, so the One Big Beautiful Bill Act, or as I'll refer to as OB3, changed the rules related to tax credit incentives for clean energy facilities that were enacted as part of the Inflation Reduction Act, which was obviously passed during the Biden administration. And the changes under OB3 are significant, to say the least. Some examples of the most relevant changes involve accelerating the tax credit expiration dates for most technologies, shortening the time frame to qualify for certain tax credits, and implementing new requirements involving what we call foreign entities of concern, or as you hear in the industry, as just simply FEOC.
Great. Thank you for that. Now, we can't cover all the ways in which OB3 affects clean energy tax credits in a generally adverse way, but there are a few code sections that weren't impacted by OB3. So if you could share that with our audience so they can know that if they have a project operating under one of the couple of the code sections not affected, that they don't need to be as concerned about these changes with respect to those projects.
Great, thank you. Yep. So if you're a developer of a facility that qualified under the old sections 45 or 48, and you started construction before 2025, then you're not impacted by OB3. Okay. And so there are a number of developers that started construction last year. Construction's ongoing, and those facilities will be placed in service, this year, the next year, and so forth. And as long as those developers started construction before 2025, they still have eligibility under old sections 45 and 48. And therefore, these new requirements passed as part of OB3 don't impact those deals. And so that's a huge benefit. Now, if you started construction after 2024, okay, so if you're in that category, but you started construction, say this year, now you're no longer eligible under old sections 45 and 48. You're in the tech neutral credits of 45Y and 48E, but if you're, say, a wind, solar, battery storage project, you're technically impacted by OB3 in some ways, but at least you won't be eligible for these new FEOC requirements. So, and there's a lot of different sort of like timeline provisions or phase out schedules within OB3 that sort of impact you one way or another. So it's crucial for folks to be familiar with and pay attention to when these various dates become effective. But the big thing I just wanted to stress there is for developers that commence construction prior to 2025, you're still eligible under old sections 45 and 48, and therefore not impacted by OB3.
I do want to compliment you, Tony. when you were on the podcast last year and we were talking about 45 and 48 phasing out and the new tech neutral phasing in at a technical level, absent future tax law changes, there weren't an enormous number of reasons to be trying to start construction, but you knew what you knew. And your advice was go ahead, start, what you know, and not be subject to the new tech neutral if you don't have to be, if you have the option. And I'm sure all those developers that took that advice are probably pretty happy that they did.
Yeah, I remember that podcast when we were talking about this, and we both kind of felt like we don't know exactly how you might regret not starting construction this year, but it's possible. And so, and lo and behold, here we are.
Yes, indeed.
Yeah.
So one of the critical parts of trying to understand the impact on clean energy tax credits of OB3 is the timeline of the various rollbacks. And once again, you can't give an exhausting look at all clean energy tax credits, but it would be useful if you shared with the audience which of the clean energy tax credits are being rolled back the quickest.
Yeah, definitely. So I really want to shine a light on those credits that expire the soonest. And so first off, clean tax credits for clean vehicles, they now end at the end of September this year. So September 30th, the tax credits for clean vehicles will no longer, be eligible. You got the residential solar clean energy credit that's under Section 25 Cap D. That credit expires at the end of this year. And then there's the alternative vehicle refueling credit. That credit will no longer be available for facilities placed in service after June 30, 2026. So those credits, if you operate in any of those industries, those credits are expiring very soon. And then lastly, which is, likely of greatest interest to our listeners, OB3 significantly changes the timeline to qualify for solar and wind credits under 48E and 45Y.
So let's talk about the solar and wind, and that would be the solar and wind that now fall under the tech neutral code sections. And maybe you just refresh our listeners as to why we say solar and wind qualify under tech neutral. There's a regulatory guidance on that front, and then share what the phase out schedule is.
Right. Okay, great. Yeah. So, wind and solar, they're provided for under 45 Cap Y and 48 Cap B of the code. They're tech neutral credits. And they're specifically listed under those code provisions as meeting the definition of tech neutral. So, with respect to most technologies under the tech neutral credit provisions, those facilities have to prove that they're zero emission generating facilities. Okay, but then 48 Cap E and 45 Cap Y, they provide exceptions for a few technologies, and wind and solar are part of that exception list where they automatically qualify as being deemed as zero emission generating facilities. Now, wind and solar were hit very, very hard by OB3. Since the OB3 was passed, now in order for solar and wind facilities to qualify for the tech neutral credits, they need to start construction before July 4th, 2026. And if they don't start construction before that date, then they'll need to be placed in service before 2028 or no later than 12/31/2027. Now, if they start construction before July 4th, 2026, they'd have a longer timeline to place in service, but they'd still have to be placed in service. They'd have until the end of 2029 to be placed in service. So again, these dates of starting construction and placing in service, very important.
So that's obviously very bad news for the solar and wind industries. And now we're operating under this new law. And as we've discussed before, there'll be future Congresses, there'll be future presidents. And what this means over the longer term is certainly unclear, but you got to operate with what you know now. And this is obviously very bad news for solar and wind. But the better or the good news is that outlook isn't nearly as bleak for other tech neutral tax credits. So please describe to the audience some of the other tech neutral tax credits and how they're affected. And I'm sure many in the audience is thinking about battery storage or standalone storage.
Exactly. Yep. No, I'm glad you asked because I think when OB3 was first passed, I think the immediate reaction was, oh my goodness, clean energy tax credits for all technologies are phasing out on the same timeline as solar and wind. But that's not the case. So if you're a developer of a technology that qualifies for clean energy tax credits that, aren't solar or wind, like battery storage and some other technologies, then the current credit amounts, they remain in place for facilities that start construction before 2034. And if you start construction
Let
in
me just
2000,
interrupt you and say that's nearly 10 years.
exactly, right. So it's a long runway. I think some people, if they just started coming into renewable energy when the IRA was passed, they may not realize that renewable energy tax credit incentives in this country have kind of been on a short leash. And, what they'll give you sort of like a short runway, maybe 3 to 5 years. And then, the industry will have to go back to Congress and lobby to sort of get those, extended. And so a 10-year timeline is actually a really long timeline for renewable energy tax credits. So yeah, so again, so if you're a developer of a technology other than solar or wind, you've got, same credit amounts in place as long as you start construction before 2034. And then if you start construction in 2034, you're eligible for 75% of that credit amount. If you start construction in 2035, it's 50% of the credit amount. And then finally, if you start construction after 2035, that's when you no longer are eligible for any tax credits based on current rules.
So I appreciate your thoroughness in going through what happens if you start construction after 2034.
Yeah, sure.
But I suspect for most of our listeners, that's probably not going to affect their planning very much.
That's right.
And I also sort of wonder if, anyways, I find it funny to be thinking about the phase down dates, 9 years from now. So let's talk now about the ability to monetize tax credits.
Good.
Did you want to say something else before we go there?
No, I'm glad you're pivoting to the monetization of tax credits topic. That's another hot topic here as part of OB3.
Because one thing to say, okay, this is when my facility would be eligible for tax credits. I do have these various rules determine my eligibility for these tax credits. Then there's the question of I need to monetize the tax credits. And when I think about monetizing renewable energy tax credits, I think of obviously principally tax equity syndication, which, has been the go-to obviously for years and years. And then with the Inflation Reduction Act, we created the concepts of elective pay or direct pay, depending on which way you want to use it, colloquially or technically, as well as transferability. So please describe for the audience how OB3 affects the ability to monetize tax credits to these three mechanisms.
Okay, great. Yeah. So, leading up to the passage of OB3, the industry was quite fearful that Congress might take away the transferability option, and transferability is something that didn't exist prior to the Inflation Reduction Act. It was new. And it became, a very popular option for new entrants into the clean energy space to, be able to participate in the clean energy industry without having to be a tax equity investor. And so transferability has been just a really popular option for both sponsors and buyers to participate in the renewable energy industry. And so there was a lot of fear that OB3 might take away that transferability option. But fortunately, I guess the silver lining to OB3 is that transferability was spared for the most part. The one exception there is that you can't sell or transfer the credits to what's called a prohibited foreign entity, and prohibited foreign entities are covered under the FEOC rules. Elective pay, or as you refer to as well as colloquially as direct pay, was also spared. Again, you can't, take advantage of elective pay with a prohibited foreign entity, but other than that, elective pay is still an option for sponsors. And then in terms of tax equity investors, investors, similar situation. You'll continue to see traditional tax equity structures for years to come, investing in facilities. I guess the new big requirement, though, is you'll have investors will obviously want to underwrite any of these new FEOC rules. And so, but for underwriting the new FEOC rules and dates on when facilities commence construction, I think you'll obviously still see traditional tax equity investors, those structures that they use, as well as transferability, and obviously elective pay whenever elective pay is an option.
So if I'm a developer of a clean energy tax credit facility and I'm reaching out to tax equity investors and I've worked with them in the past, what are some of the ways in which they'll change and alter the way in which they evaluate or prioritize various facility under development?
Definitely. So if you're an investor looking for credits, I'm going to list these kind of in order of priority. So what I list first is top priority. So if you're an investor, you are absolutely going to prioritize those section 45 and 48 credit transactions that I mentioned earlier that are not impacted by OB3. And so if you're an investor and you're talking to developers, to the extent developers have projects started construction before 2025 or during 2025, right? Those credits are going to be prioritized the most, especially the deals that started construction before 2025 and still qualify under old sections 45 and 48. So that's kind of tier 1. Tier 2 would be tech neutral credits. So these are facilities that started construction after 2024. Okay, but they started construction this year. They started before 2026, and as a result, they won't have to comply with FEOC. Okay, now I'm assuming that your old 45, 48 credits, those deals started construction before 2025. And I'm thinking,
before 2025. Yep.
Yeah, before 2025. A lot of those credits they'll start hitting the market, meaning the facilities get placed in service. Obviously throughout 2025, those again, I'm talking about the deals that started construction before 25, right? Those facilities will hit the market in terms of their credit flow in 25, 26, and then you'll even see some stragglers there into 2027 as well as 2028. Okay. Yes. Now, for facilities that started construction this year, again, those are under the tech neutral credit provisions, but they won't be subject to FEOC. Those credits will start to hit the market in 2026, probably a pretty good flow there, and they'll continue into 2027. And if those facilities started construction, again, I kind of alluded to this July 4th, 2026 date earlier. So if you've got some facilities that start construction this year, even before July 4th, 2026, those facilities, those credits will hit the market, and they'll remain in the market right through 2029. Okay. Then you've got the group of credits now moving down to like tier 3 here. If you got section tech neutral credits, so these are facilities that started construction after July 4th, 2026. Those facilities, not only will they be subject to the FEOC requirements, but they'll have to be placed in service before 2028. So they'll be under the greatest amount of pressure to get placed in service. And I think those credits will sort of be like last priority, if you will, in terms of investor demand. And then lastly, I want to draw a little bit of attention to 45X. The 45X credits that are generated by advanced manufacturing facilities, those have been very popular, especially with the tax credit transfer buyer market. Now, with respect to 45X, there are like a lot of different expiration dates there in terms of how the phase out for 45X works, and it's based on like the type of component or mineral that's being manufactured. And so really the dates there are super important with 45X. But I just want to point out that with respect to the transfer market, 45X credits have been very popular since transferability came out, and I suspect they will continue to be in high demand as long as they're within their sort of phase out time limits.
And when you were mentioning the various categories, when you talk about these various categories, I believe you were to think about this in the context of solar and wind. Is that correct?
Yeah. Yes. Yep. Thanks for clarifying. Yep. And even with respect to FEOC, so if you've got, like, let's say you're working on a standalone battery storage project or a fuel cell project, right? Or a geothermal facility. If you start construction this year, you're still, you don't have to comply with FEOC yet.
Right.
And so there'll be some, if you got a battery deal that started construction this year, it'll obviously be in more demand than a battery storage project that say started construction after this year.
You obviously gave more from the standpoint that there's not, the placement and service date ends up becoming different in terms of, instead of being 2028, it's 2020, 2034.
Yeah,
So
yeah,
longer period of
exactly.
time.
Yeah, when I was right, I'm glad you asked that clarifying question. When I was talking about the placement service dates, say before 2028, if you will, that was definitely specific to solar and wind.
So now let's talk a little bit more about foreign entity of concern or FEOC restrictions. Please, once again, at a high level, and maybe I'll have you back on a special podcast for a deeper dive into FEOC, which I don't think is going to be our highest of watched or listened to podcast. But for those that are involved here, it'll be something they'll really probably be emailing us to say, please do a podcast on FEOC. And maybe if we get enough requests, we will do one. But if you could just describe the foreign entity of concern or FEOC restrictions at a high level, and maybe start by explaining why they even exist as a concept, from a policy perspective, because I always find it easier to remember rules when I know what the underlying policy purpose is.
Great. Yep. So FEOC, right? Foreign entity of concern. And so what is a foreign entity of concern? There's some nuanced definitions around the foreign entity of concern concept, but big picture, foreign entity of concern would be obtaining material assistance or buying a certain amount of materials or goods from either China, Iran, Russia, or North Korea. And so from a policy standpoint, you can see that one of the goals here is to, lessen our business interaction, if you will, with those countries. Now, in renewable energy, I'm not aware of any major component suppliers or financiers that come from, Russia, Iran, or North Korea, but China supplies a significant portion of the components used in renewable energy facilities in this country. And so you can tell that from a policy standpoint, the country would like to change that, where we're sourcing more of our materials domestically. So it's sort of to encourage domestic manufacturing, increase domestic, manufacturing jobs and that whole economy, and sort of start weaning ourselves off of the amount of components and assistance we are used to with countries like, say, China. And so, yeah, we could do a whole entire podcast on FEOC requirements. We're not going to do that today, but I know our renewable energy clients would love to have us do a podcast on the FEOC nuances. But for now, let me just say that unless a facility started construction before 2025 and therefore falls under the old sections 45 and 48, which again aren't subject to FEOC, then it's safe to assume that if you start a construction or if you're starting construction next year, you're going to be subject to the FEOC requirements and all the related requirements for all IRA related clean energy tax credits to start after the date of the OB3's enactment, with very few exceptions. So, although I'm not going to go into all the nuances of the FEOC rules, I would like to highlight that the FEOC rules include two types of categories, and they are referred to as specified foreign entities, and then the other is foreign influenced entities. And these specified foreign entities and foreign influenced entities, these are both considered under the FEOC rules to be considered what's called prohibited foreign entities. And prohibited foreign entities cannot claim clean energy tax credits. That's very important to know. In addition to that, in order to qualify for clean energy credits, once the FEOC rules become effective, the project can't receive material assistance from a foreign entity concern. And so that would be a prohibited foreign entity. And again, a prohibited foreign entity can either be a specified foreign entity or a foreign influenced entity. Okay. And there is in order to prove, a taxpayer will actually have to prove that they didn't receive material assistance from a foreign entity of concern. And there's a cost ratio that the IRS requires taxpayers comply with. And the cost ratios, they actually vary depending on the type of technology. So if it's a solar facility, the ratio is one thing. If it's a battery technology, it's another ratio. And so the ratios are really important to sort of focus on here. But big picture, the cost ratio analysis borrows heavily from the domestic content rules. And so if you're in the renewable energy industry and you're familiar with how to comply with the domestic content rules, well, then you've sort of got the fundamental understanding to help you get started with doing this material assistance cost ratio requirement under the FEOC rules. And if you're familiar with it or not, I can just say that, our firm has done a lot of work in the domestic content space, helping clients analyze their costs of components that they acquired and figuring out if they meet the domestic content rules. And so we are in the midst of developing our FEOC service line as well to help clients document compliance with this material assistance cost ratio analysis. And then lastly on FEOC, I'll note that taxpayers, they cannot claim clean energy tax credits if they license critical technology from a prohibited foreign entity, or if they make any significant payments to a prohibited foreign entity. And so I want to highlight those aspects. Again, some high-level definitions around, FEOC, again, prohibited foreign entities, as well as highlighting that the fact that there is this material assistance cost ratio that applies, and then you can't license technology from a prohibited foreign entity, and you can't make significant payments to a prohibited foreign entity. But be on the lookout for a FEOC-related podcast in the near future, and we will sort of look under the hood deeper at the various nuances of the FEOC rules.
So maybe share with the audience what you're hearing from developers in terms of the challenges of sourcing components, a sufficient number of components domestically versus from a foreign entity of concern.
Yeah, it's very stressful. As I kind of alluded to earlier, there's so many components that are sourced from China in the renewable energy industry, which again is a foreign entity of concern. So you can imagine it will be, very difficult for developers to source all the components that they need from countries other than China. And I think it's going to take a while, obviously, for the US to ramp up its manufacturing capabilities to sort of provide all that component and all the components and materials needed to meet the energy demands in this country and all the facilities that are expected to be put online in the coming years.
Maybe you could also share with the audience a little bit more about the service that you provide to help developers document compliance with the FEOC provisions, because it's obviously something that developers aren't the only ones concerned about. They're concerned because they're going to be providing guarantees. Investors are going to be concerned, obviously, as well.
Exactly. Yeah, beyond finding the components and materials, which is obviously the primary issue for developers, there's the whole issue of documenting compliance, which is apt to be time consuming and costly. But again, our firm has been helping the tax credit industry, not just renewable energy, but the broader tax credit industry with documenting compliance with just a whole host of different tax compliance matters for decades now. And so we usually perform those services pursuant to what's called an agreed upon procedures engagement, commonly referred to as an AUP. And it's a type of deliverable that just for whatever reason, tax equity investors and their attorneys find it to be a very useful deliverable to help underwrite and get comfortable with the degree in which a developer is actually complying with some of these tax matters. And so we will definitely do that for FEOC. We also do that for domestic content, prevailing wage and apprenticeship, beginning of construction. I could go on and on. But we have a FEOC AUP it's been workshopped internally. It's being shared with members of the renewable energy industry, and I expect that to be in circulation, in the coming months.
Yeah, I'm sure you'll be discussing at the next Renewable Energy Tax Credit Working Group as well.
Thank you. We will be discussing it at our next Renewable Energy Working Group meeting, and then at our conference in DC that you mentioned at the beginning of the podcast. We have a Wednesday pre-conference workshop, and during that workshop, we'll have an entire segment devoted to FEOC and some of these other issues.
Great. So I'm now curious what actions you're suggesting to developers and investors that they prioritize right now. And I'm going to, one I could pretty quickly see as a bit of a layup, and that is start construction in as many facilities by the end of the year as you can.
That's right.
From a timing perspective, but obviously it then becomes a question as to what start of construction means. So with that as an introductory question, if you could take it away and share what sort of initial advice you're giving developers and investors about what they should be prioritizing right now.
Thanks. Yeah, so the IRS allows two different approaches for a taxpayer to demonstrate that they commence construction. So, I definitely would start construction on as many facilities as possible, as soon as possible as well. Now, the IRS allows two different approaches there to consider. One is referred to as the 5% standard, and the other one is referred to as the physical work of a significant nature approach. You don't have to meet both. You can pick one or the other. If this were my project and I had to start construction, I would probably lean towards the physical work of a significant nature approach right now. And I would prioritize that on as many facilities as possible. And so when you work under the physical work standard, under that test, you can do work that's on site. And you can also, the IRS also allows for some work to be done off site. And if you're talking about solar, typically that involves things like transformers, where you hire a transformer manufacturer pursuant to a written binding contract, and they do work on the transformer at their site, and that can qualify for physical work of a significant nature under that standard. And so if it were me and this were my project, I would be prioritizing the physical work of a significant nature standard. I'd be doing it on as many facilities in my pipeline as possible. And I would focus on facilities that you have a pretty clear line of sight on. Now, if I was going to look at the 5% safe harbor standard, I guess if I was going to do that, I think I'd prioritize that on facilities that are already identified by location and either have things like an interconnection agreement in place, or maybe have already received notice to proceed to start construction. And so that's kind of how I'd prioritize the start of construction. Again, I'd probably lean more towards physical work. And if I was doing the 5% standard, I don't think I would want to use the approach where I go out and I'm looking to buy a lot of components, say like a bunch of solar modules, and looking to allocate them to facilities, that are to be determined in terms of location at a later date. That's been done before in the past. I don't think, based on the executive order that was issued, if you sort of read between the lines there, you can kind of tell that the White House, at least, doesn't love the idea of developers buying a bunch of components and then just determining at a later date where those modules are going to wind up. So I probably wouldn't, take that approach. Again, we've seen that before in the past, but I'd probably steer away from that going forward if it were me.
And I guess kind of underpinning, that's why I'm glad you mentioned the executive order that the White House issued last month that basically instructs Treasury to review the existing rules. And so it sounds like you're like between the lines, and obviously the concerns and the rest, that your recommendations are based upon the fact that maybe that 5% standard won't be continued. We'll see. Nobody knows.
Right.
I'm hopeful that it will. And we know that there are many senators and representatives, Republican senators, representatives that are working on behalf of not changing the guidance, particularly since that guidance is part of the statute for FEOC, if I'm remembering correctly.
That's right.
So to have two different standards seems odd. That being said, we don't know what guidance Treasury is going to issue, but it was instructed within 45 days. Is that right?
That's correct.
So
Yep,
45 days. So so hopefully sometime or the next 30 days, we'll get something. And I've got to believe whatever we get from Treasury is going to not be as exhaustive, because what can you do when you're told to do something in 45 days? It can't be as exhaustive and expansive. but it definitely, can change. It definitely obviously will influence what steps clean energy developers take. And your advice is pretty sound. And then once that sort of comes out, obviously there'll then be additional assessment as to which of the approaches are viable and investable, because it's less about the facility developer being comfortable with, quote, the risk. It's more about does that become investable? With that said, what other sorts of guidance, or how would you want to expand on that in terms of what we should be looking for from Treasury in the weeks and months ahead in terms of additional guidance with respect to a host of issues that I know we're talking about in the Renewable Energy Tax Credit Working Group that are starting to surface with respect to the legislation?
Right. Yeah. So in the short term, I anticipate that we will get a response to the White House executive order, providing some additional clarity on things like begun construction. We might get it by the end of next week, but at the latest, I bet we'll get it. I anticipate we'll see something this month. And yeah, it's hard to say what's going to be in there, but if you just kind of read the tea leaves a little bit from the executive order, they kind of make the impression that one thing they favor is starting construction on facilities where they really know the location. You kind of get the impression that they don't like it when a developer goes out and buys a bunch of components and then just divvies them up to facilities down the road once they finally determine them. So that's kind of why I sort of think they, if anything, favor the physical work of a significant nature standard, because under that approach, you have to really know exactly where the facility is to perform that physical work of a significant nature. So that's kind of why I kind of lean more in that direction in terms of like which approach I would prioritize if it were my facility. So I anticipate, a response to the executive order. With FEOC, there's Treasury and the IRS, they have until the end of 2026 to provide final rules on FEOC. But until then, they've made it clear that until the IRS and Treasury publish final rules on FEOC, the industry can rely on a safe harbor that was issued in the domestic content area. And there's a in domestic content, there are some tables that you refer to figure out how you comply with domestic content. And so until we get final rules on FEOC, the industry can rely on this safe harbor that was issued for domestic content, which is helpful. So that's what to be on the lookout first and foremost.
And is there any follow-up legislation or technical corrections that you're looking at and thinking, the industry should be advocating for beyond the notion that maybe the whole rollbacks and phase downs shouldn't be in place to begin with, but some middle ground legislation that you'd be looking for?
Just big picture, right? We, as the IRS and Treasury puts out additional guidance with respect to OB3, one thing we definitely want is we want that guidance to be prospective as opposed to retroactive. And then we would obviously want, if there are any additional changes that come out as part of OB3, we would obviously like whatever clarifications or changes to allow for at least some sort of grace period for the industry to react and pivot in order to comply with. So really prospective guidance with a grace period to adjust. And that's especially, as we wait for this response to the executive order, we definitely want any changes to the beginning construction criteria to be on a prospective basis with a grace period built in.
Great. Thank you. And I appreciate you responding to the question you wanted to answer versus the question I asked. I totally appreciate that the focus now needs to be on Treasury and the guides of Treasury issues. And I would say, which I know you agree with this, that it apply prospectively, but let the taxpayer have the ability to elect retroactive application. So it's optionality for the project, for the individual facilities. And that's all on that, because all eyes are on Treasury now in terms of an IRS to get guidance. But in terms of, if there are any technical corrections that you've identified yet, there have many that I've identified that you.
Yeah, not yet. Yeah, that's definitely something that our Renewable Energy Working Group is looking at. And the Renewable Energy Working Group it's a group made up of various renewable energy stakeholders, participants, et cetera. And some of the things that they do is they try to figure out where consensus is lacking and where additional clarity is needed or technical corrections made. And so, that's a key focus of our group. But right now, at this moment, I'm not aware of any technical corrections that we're, anxiously anticipating.
Because there was, I won't go back, but there was the grain glitch as part of 2017, and that led to bipartisan legislation to fix the grain glitch. And it led to, negotiations between Democrats and Republicans in the House and the Senate to try to resolve that. So if there are technical corrections, and that could maybe accelerate the chances of another tax bill happening on a bipartisan basis. Thank you for being the guest, Tony. I do want to ask you if there's any other recommendations you have to our audience or other thoughts you want to share with our audience before we get to our off mic section. So this is a bit of an open forum for you to share any parting advice.
Yeah, so I mentioned the Renewable Energy Working Group, and that's again, it's a great consensus group comprised of investors, developers, attorneys, consultants, et cetera. And so during times like these, when you've got new tax rules that come out and there's a lot of confusion, the working group can play such an important role in terms of helping to stay informed and understand where industry consensus is on a variety of issues.
I definitely agree with the industry consensus, because you definitely want to be traveling with the herd at times like this, so that you're not the one that's away from the herd that the IRS makes an exception of. So thank you, Tony. Obviously we could talk much longer, and I'm looking forward to that FEOC follow-up podcast. It sounds like I suspect many of our listeners and viewers are as well. To our audience, I will share your email address in today's show notes. And please email Tony with any questions that you have, as well as if you're interested in joining the Novogradac Renewable Energy Working Group, email Tony or email cpas@novoco.com. Before we get to the off-mic section, I do want to, and I do this every week, just remind the audience to subscribe to the podcast on whatever platform you use. Also, please do share the podcast with your colleagues. It's a great way to stay educated and stay up to speed on the latest developments. And those of you watching on YouTube, please take a moment if you can, just a quick little like would be wonderful. A comment would be even better. By liking and commenting the video, it raises our visibility and helps others see and hear some of the important discussions we have on the podcast. And then you can also check out our Renewable Energy Tax Credit Finance Series playlist if there's something if you're in a binge watching mood. And also, we do have a full archive of episodes on our website at novoco.com. So thank you for watching and listening. We now are going to go to our off mic section. And we like to use this space to give a shout out to someone or someones working in the areas that we work. So Tony, who would you like to shout out this week?
Great. Yeah, so normally I shout out a person, but this week I'd like to shout out a group of persons. So I've been talking about the Renewable Energy Working Group, so I'm going to give a shout out to our Novogradac Renewable Energy Working Group.
Great. Thank you for that. It sounds a little self-serving to say I echo it, but I don't know. So Tony, thank you for being on the podcast today. And
thanks for having me.
Audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.